All right, good evening, good evening, good evening. We're on our fourth live stream now on the channel. So, diving right into the topic, we're going to be covering real estate financing or funding stacking for 2025 for real estate investing. So, we're going to be focused on the various products, lending products, and tools that are out there for real estate investing. Some you may be familiar with, some maybe not so. And we're going to kind of paint a picture on how you can stack these together to get yourself in on your first properties or your next properties. We're going to try to break this down in an order of the most traditional forms and then work our way over to those more obscure or less traditional, less conventional forms of financing. So before we get into that, anybody that might be coming into this new, catching the replay, I'm JP from Blueprint for Prosperity. The basis, the principles of this channel, as far as what I'm looking to provide to you as my viewers, is going to be mastery of relationship banking, maximizing your borrowing capacity, proper use of life insurance as an asset, and the ownership of real estate. These are the major founding pillars that the majority, if not all of my content is centered around for the most part. So the goal is to help you learn how to navigate the banking system, which will lead you to quality access to capital, which once you have, you can deploy into assets, and then you can implement tools like life insurance as a supportive asset once you've gotten to a certain financial position. So we're going to be covering these real estate tools. You'll kind of see me looking over. I know live streams sometimes get kind of fancy. This is my fourth one. I've done hundreds of videos on this channel. It's only my fourth live stream, so y'all bear with me on not having the fancy pop-ups, graphics, charts, etc. We'll work that in, down the line as these live streams get more and more consistent. For now, I just want to give you guys raw conversations. So you'll see me looking over at notes from time to time to make sure that I'm covering the things that I want to cover and staying on topic. That having been said, when you guys start to come in on the live stream, be respectful. Let us know you're in the building. Say hello. Let me give you a shout out. You always know, for those of you who are catching the replay, if you don't catch the live stream live, watch the video from beginning to end. You guys know I don't do fluff in my videos. My live streams is going to be packed with information. Leave your questions in the comment section. Like the video, support the video, share it if you find this information useful for other people around you, so you can continue to support the channel and can continue to broaden out this knowledge base. So to get started on this, as I stated, we're going to focus on this from a traditional financing methods that are available, and then we're going to branch out into less conventional or less traditional forms of financing. In an ideal society, in an ideal world for us, we would have the major components or pillars that all underwriters and financial institutions are looking for to qualify for their lending products. And that's going to be really broken down into three major categories. From an underwriting perspective, I talk about it a lot on the channel. If you follow other quality finance content creators, you may have heard a couple of them mentioning here and there. But there's really about a baseline of three major things that underwriters are looking for to lend against. That's going to be credit, so having a good financial reputation. Think FICO scores, Vantage scores, and the profiles behind those scores. Cash flow or cash reserves, I kind of lump those together, but basically having the excess cash flow monthly or having the excess cash in the bank in a lump sum. The next is going to be some type of tangible or intangible collateral. So tangible, think real estate, equipment, vehicles potentially, etc. Think something tangible that can be exchanged for value and that will typically do reasonable at holding value. Intangible collateral is going to be something like invoicing, things of that nature. A book of business, if you're a financial professional, and believe it or not, there's lending around books of business, insurance professionals especially. So something that's not necessarily you can put your hands on it per se, but it's still a legitimate, financial instrument of some sort or business instrument that the financial system or the banking system looks at and says, this is something that I can exchange for value. So if you don't pay me back, I have a way of recouping some or all of my money. So In an ideal world, we'd have all three. We have great credit profiles. We'd have great cash flow and cash reserves. We'd have great collateral. The reality on the ground, the reality of the situation is most of us either don't have any of the three, we might have one of the three, and if we're fortunate, some of us have two out of the three. But many of us that aren't just massively financially successful, usually we don't have all three of those. The financial world, the banking system, the lending space understands that and has adapted over the years to put out more and more products to meet the needs of those of us who want to participate with leverage when it comes to, let's just say, the game of real estate investing. There's products that have evolved around what we may have available to lend against. And that is what we're looking to dive into in this particular live stream. We're looking to illuminate or put light on the various lending products available that may meet our obscure needs if we only have one out of those three major pillars, or maybe one and a half or two of those pillars. There's a financial product that is out there somewhere, most likely lending product, that you can get your hands on to help you get started sooner with real estate. And if not, the channel is designed to help walk you through and bring you the context needed to develop your finances in a way that will allow you to get at least one, if not two, or ideally at some point, all three of those major C's underwriting, tools checked off. So traditional financing is your ability to be able to walk into your bank, your brick and mortar bank most likely, and apply for a real estate investing loan directly and have everything they're going to be looking for. The vast majority of brick and mortar banks are going to be doing full underwriting, or what we say in the industry is fully underwritten. So what that basically means is they're not going to pick one or even two out of the three for you to qualify for that loan. You're likely going to have 2 to 3 out of the three to qualify for a fully underwritten loan. So I'm going to kind of leave a caveat, because you don't necessarily have to have collateral in fully underwritten situations when it comes to real estate loans. So I do want to put context on that. You don't have to have other collateral. It helps the deal if you do have it, but it's not something that's a guarantee. So I'll backtrack a little bit and say that you need to have 2 out of the 3 intact for fully underwritten loans, which is the majority of your brick and mortar banks and credit unions and institutions. Some of them get pretty flexible and creative, but generally speaking, when you think about single family 2 to 4 unit real estate, which is kind of where we're focused at the moment, we haven't branched out into commercial. So think single family 2 to 4 units. You're going to be looking at fully underwritten loans in many cases. And again, you're looking at having 2 or 2 to 3 out of the 3 major underwriting pillars in order to qualify under that particular loan product, or those loan that family of loan products. So my goal on the channel is generally to, my guy PNR, love to see you back, my guy. I hope you've been doing well the last week or so. My goal on the channel has been centered around helping you guys get to all 3 of those pillars, as I'm on the journey to all 3 of those pillars. The reason for that is because it's a lot of hard work. It's a lot of positioning. And we're going to talk about that a little bit more in a minute. But generally speaking, you having all 3 of those pillars puts the ball in your court in a way that you can't have in any other capacity. When it comes to dealing with financial institutions and lenders, when you start talking about getting into real estate, investing and looking to make a profit, build a legacy, build a portfolio out, ideally, we want the power when we walk into those negotiations and those conversations with banks. That's just what it is. Being someone who works in the corporate world for a financial institution and also has a pretty deep background in brokering and independent brokering in the alternative lending space. So think business financing, real estate investing, lending, is and all of that space. I have a pretty reasonable background in that space as well. So I kind of have this beautiful hybrid of understanding underwriting from a fully underwritten perspective, and also understanding the large majority of us, or a large pool of us, that just don't have all of that together, and still we're working hard and we're putting it together best we can to play the game. So ideally, the goal on my channel is to try to bring you the kind of content in the various forms that I bring it, to help you get to all three of those pillars. And just to rehearse that, because I know you guys are starting to come in slowly but surely for those coming in live, it's going to be those three major C's when it comes to underwriting that you need. One of the three, two of the three, ideally three of the three, to qualify for some type of lending product when it comes to financing, really in any arena, but especially in the real estate space. That's going to be credit, the credit score and the profile behind it, cash flow, cash reserves, and collateral. Having those three, one of those three, two of those three, three of those three. My goal is to bring content that will get you to the point where you have all three of those, because I want you to be able to walk into any financial institution and have complete control over those negotiations. And the only way to do that is to have what they love, which is going to be a lendable profile. When you're lendable by their eyes and their standards, especially at a prime level, great credit, good cash flow, good income, good reserves, and you have good collateral behind you, you've played the financial game at depth, and they can look at your records, they can look at your file and say, this person's legitimate. There's nothing that a bank makes a bank happier. Literally, there's nothing that make a banker, a bank, a branch manager, a relationship manager happier than seeing that you are actually lendable, because that is where the money is for the vast majority of us in the financial services space. So my goal is to bring the content to incrementally get you there. That having all been said, I am well aware that many of us are on a journey of either building out from scratch or rebuilding. We had rough starts. We didn't make the best decisions. We had to go through those learning curves. We didn't have a lot of guidance, et cetera, et cetera, et cetera. I understand it because I can check most of those boxes. This is my financial revival in the last 6 to 7 years or so. And that's even with me being in the financial industry for years before I collapsed financially in the past. So I understand that. And that is partly why I ended up in the alternative lending space, brokering space, et cetera, because I saw such a massive demand for that. And I also developed an amazing education because I was in a situation where I needed alternative lending and financial resources. I couldn't go to a bank for very much. So the point of that is I want to be able to present options to you now that you may have available to you, that you may or may not know is available to you. And I also want to present options to stack or pool different resources you have to put a full financing or lendable portfolio together. So if you can either go to your bank or you can find alternative funding options to get involved in real estate. I've already made the case on this channel a dozen times or more in the last, really since the life of the channel, but for sure since 2023, on how real estate, especially single family and 2 to 4 unit residential real estate, is highly likely going to be a hot asset class continuously throughout the rest of the 2020s. It already has been, really, since the 2008 recovery situation has taken place. 2010, 2011 was like the end of the bottom in residential real estate. If you track the numbers, it's only been up since that point in time. I don't think that run is over yet based on all the data that I see. So that basically means getting in sooner than later will be optimal for all of us, primary residents and investment properties alike. Getting in on residential real estate is going to be optimal. For one, for us to make as much money and build out a strong portfolio, financial portfolio as possible. Number two is to not get priced out of real estate, period. Not just from making money and profiting. That's actually, obviously that's a big focus for us. But, the reality is that pricing of real estate going up, the demand for real estate going up, the population and demographic changes in this country, the money that constantly is pouring into real estate in this country is going to make even renting and not owning really expensive. It's going to make it really expensive. So let's get into some options. We started with traditional financing. We know we need around 2 out of the 3 major underwriting C's, if we want to call it that, in order to qualify for traditional bank funding. good old-fashioned traditional bank funding for real estate. Good credit and good cash flow slash cash reserves. Creative ways to come up with that cash portion. There's a lot of money from banks. There's a lot of money from the government. And of course, you can get creative on your own. But at the end of the day, you're going to pretty much need 2 out of those 3 in order to qualify. Collateral is not usually a big pressing need for traditional funding, but it doesn't hurt if you have it. It looks good if you have 401ks, IRAs, stock portfolios, other real estate you own. It looks great. It helps your profile. If we start to drift out a little bit, the next is going to kind of be the private lender, hard money, and private money space. So this is going to be a scenario where you typically need 1 out of those 3 C's to qualify for funding. They are typically going to be predicated, it varies, but they're typically going to be predicated on the property or the deal itself. They're looking at the collateral portion out of those 3 C's. You don't usually have to have a ton of money into the deal. You might need some skin in the game depending on the circumstances, but again, not a ton of money in the deal, nowhere near what traditional bank funding will usually expect from you. And then you typically don't need to have the best credit in the world, though they still price their lending off of your credit a lot of times. So it's not always irrelevant, but it is not a predicating factor of like, you can't get this without a certain score. Not as common in the hard money, private money space. And I know that firsthand as, brokering in that space for a long time. Now, I know it's changed a little bit since I've been in it, but it hasn't changed that much. So collateral is the big C when it comes to hard money, private money. So that means that you have creativity when it comes to the cash into the deal part, and you have flexibility when it comes to credit requirements, though it is attractive to have your credit together still. That always is ideal. They still do pricing on your credit in those deals a lot of times, unless your private lending is literally like meeting a stranger or somebody a family member or coworker that has money to lend you for a real estate deal. That's a different story. But when we talk about private lending, that's a game of semantics between hard money, private money is kind of like interchangeable in the alternative lending space in real estate. So think family offices, hedge funds, just etc. These different entities that exist that have really either large books of money themselves or have been tasked by other entities out there, Wall Street, hedge funds, etc., to deploy this money into the financial system and get a return. So private and hard money is relatively interchangeable. Collateral is the baseline. So to think about stacking in this arena, you need to either have a really sweet real estate deal to get 100% financing and to not have the best credit in the world and still qualify. And so that means that deal needs to typically have a lot of room for equity. Most of the time, you're talking about buying properties that need work and that you can add value to. And that after repair value or ARV is going to be handsome enough to where the lender feels comfortable that everybody's going to make money if it goes right, and that they have something to sell and get their money back if they have to take that property from you because things went wrong. So very important to understand that dynamic when you're looking at hard money and private money. They're looking very much in most cases at the real estate deal itself. There's other intangibles at play, like your reputation or your experience within real estate is a big one in that space. There's a whole different dynamic of lending for those who've done real estate deals versus those who are brand new. Like newbie investors have a whole little, niche bucket of lending tools available versus those who have done a handful of real estate deals in some variation or another. It even matters a lot of times if you own your primary residence in the private hard money space. Real quick, I see a few people popping in. You are popping in. I see a few. Drop a comment in the chat. Just let me know you're in the building so we can get just say hello, be formal, house training, having manners. And, obviously, as you guys hear me go along, if you have questions about what I'm talking about, I will take a second to try to answer those questions. But I'm going to try to get through this. All is well with me, PNR. All is good, man. I survived Hurricane Francine. You know, if you guys were watching that play out, got hit pretty hard as far as the direct path, but made out pretty good from it. No damage on the house. Power was out for a while, but survived and made out okay. So I'm pretty good, my man. So we know collateral is a big deal. Owning your home can make a difference. Having experience can make a difference. At the end of the day, most times than not, if you can come up with a sweet enough deal, a lot of the rest of it can be negotiated as far as credit scores, cash in the deal, not having experience, maybe not owning a home yet. But these are important components to know. So, scenarios for stacking with private and hard money. The best, if you're not going to come in with the credit portion in private and hard money, you have the deal, or you plan on lining up your capital to get the deal. The way you can get creative a lot of times is with the cash part. Private and hard money will still prefer you to have cash down or skin in the game, even if it's just earnest money deposit. It may not have to be down payment per se, may or may not, depends on the equity in the deal and the details of the deal. But if whatever earnest money or money that needs to be input on the repair of the property, potentially, this is where you have room to get creative. So you have the ability to come up with the cash that may be necessary for your earnest money, potential deposit, or money they may want you to put in on the rehab of the property. You can do that a magnitude of ways. There's lower risk ways, and which are some obvious ways, and then there's not so obvious higher risk capacities. So you can do the obvious and just come up with the cash legitimately the regular way. Work hard, overtime, side work, etc. If you're in a scenario where you're just anxious to get into real estate and that's not at your fingertips, honestly, I would encourage you to just continue to work on your finances. But again, focused on trying to help more of us get in on real estate sooner. And you have, for whatever reason, a knack for finding the good deals, or you've just found a good real estate deal and you just really want to capitalize on it. Then you have the alternatives of using strategies like, credit cards. There are hard money lenders out there and private money lenders that have, that will allow you to use credit cards for, the cash in your deal. It does exist. It is risky business. And I plan on talking a little bit more about credit cards a little bit further on into, as the one of the funding options. But just in the moment of coming up with the cash for private or hard money, credit cards are often, or sometimes, not I'm gonna say often, but sometimes a respectable tool in a real estate deal with a hard or private money lender. They are already kind of in a mindset of going against the grain and using alternative means. And the pricing in private and hard money, on average, there's exceptions, but on average, is steep a lot of times. They're pricing in for risk 110%. So they are already in that mindset of pricing high on, for risk, expecting their money back pretty quickly and wanting a lot of spread on the property. So they're a little bit more open-minded and flexible to these non-traditional ways of kind of coming up with cash. So you can use credit cards. Peer-to-peer lending is another one that's on my list. If you are not in a position where you can go into your bank and just go get a loan, then, peer-to-peer lending is a scenario where, platforms like Lending Club and Prosper, and there's a couple other that exist out there that have platforms to get put together where, you can basically present yourself on that platform as a borrower, what you're borrowing for, and get people to invest their money into your lending needs, basically. If you don't have great credit or the best financial situation in the world, you can still qualify for financing. It's just more expensive. But peer-to-peer lending is another one that is on my list. So coming up with creative ways of cash exists with private and hard money. If the deal is sweet enough, you might not need it. But you have to remember, You're looking at a scenario where out of those 3 C's for underwriting, when you're down to just having one, in many cases, you're going to have to compensate, or you're going to have to be prepared to pay for that risk that you're presenting, because you only have one major, underwriting tool that a financial institution, bank lender, hard money lender, private lender, family office, hedge fund can lean on when they're lending you money. And that's risky for them. So what are some other alternatives? You can blend private and hard money with your retirement accounts, meaning if you think about 401ks, there's 2 different ways you can use financing in 401ks. 401ks you can use while they're active. You can use some of those funds towards your business. It's typically more of a startup funding strategy. But obviously, if you're investing in real estate, more times than not, you're going to be doing it in a business entity or encouraged to do it in a business entity. And there is a way, there is a funding option where you can use your 401k towards like startup funding for your business. That's one way. Another way is going to be to potentially collateralize your 401k, which is typically more of a scenario when you're no longer working. That 401k is no longer active, you're no longer working there. It's more likely when that's going to kick in. But it is a thing. And you can sometimes get up to 90+% of that 401k lending, like money back lent to you of the value of that 401k. So that's an option that's on the table. That might be a tool in your tool set that you may have. The other alternative is, if staying in the realm of like stocks and retirement accounts, IRAs also fall in that bucket. You can also lend against those as well. You have self-directed IRAs. So that's going to be a scenario where there's these, there are these companies that exist that really specialize in self-directed IRAs that, it's a little bit of a regulated and tedious process, but essentially a business entity is created, and through proper means that IRA or retirement account is rolled over into that entity, and you're given like checkbook level access. There's a lot of rules and red tape around it, but it does exist. So self-directed IRAs are a thing, and they can be used towards real estate deals. They're not necessarily going to be something that you can use for active real estate deals you're going to pay yourself for at that time. The red tape, part of the red tape around self-directed, IRAs is going to be that has to be real estate deals that you're putting back in that bucket, if you want to call it that, and saving for retirement still. So 59 and a half, basically. So that's something to keep in mind if you're looking to actively get money out of your real estate deals now. The self-directed route might not work for you, but it's good for you to know it exists. Securities-based lines of credit. I've talked about it before. I am a big fan of them, generally speaking. They are available at various brick and mortar institutions, believe it or not. They are also available in the alternative lending space. So think about a stock portfolio and being able to access, depending on the platform, 30, 50, 70% sometimes, maybe even higher in some occasions. But usually there's an okay spread because stocks have that fluctuation component. But you have securities-based lines of credit. So this is where you're going to get a line of credit created against the value of your stock portfolio. And usually because of the nature of the product, you typically don't have credit requirements. Sometimes, but typically you don't have credit requirements. And you can get a decent amount of that portfolio, and it's in the form of a line of credit, and it's usually well priced as far as the interest rate is concerned and the flexibility of payment for a period of time. So it is a very attractive product when you have an existing stock portfolio that's of any size, and you're looking to not disturb that money, but you still want to deploy it into real estate. So securities-based lines of credit are great assets, great tools to have to leverage existing financial tool that you have, collateral, and still expand yourself into real estate and kind of put your money to work in two places at once, in a sense of speaking. You're obviously still paying for that product, so very important to understand. It is borderline risky, because if you over leverage yourself in it, and for whatever reason your stock portfolio takes a little bit of a beating, then they're gonna be looking to call in that money to make themselves whole. That institution that's lending you out, but it is mostly available on a private client, private bank level. So typically, this is something that's a game that has to be played at 6 figures or higher on a portfolio. There are platforms that will let you do it at a lower scale, 50 grand, etc. But when you're doing it with banks and institutions, $100,000 is kind of the baseline in order for that to work. They're not usually going to play with it in a smaller amount than that. But if you have $100,000 in a stock portfolio or a bond portfolio, account in this case too, then a securities-based line of credit could be a really attractive option for you to deploy into your real estate deals, or to use to get into your real estate deals. And again, combine it or marry it with private money, hard money deals if necessary. Potentially even with traditional brick and mortar banks if you have, good credit to go along with it. We're trying to solve for the cash part of the equation, because honestly, what I've noticed is that's the biggest struggle out of the 3 C's. Credit is a rough one for a lot of people, but cash is a big one. Cash is a big one. And so securities-based lines of credit is going to be another one. So we also know that you're going to have HELOCs and cash out refinances on existing real estate that you have. We need to talk a little bit about this one, because there are some distinct differences between a HELOC, between a refinance, and then cash out refinance and HELOC. There's some variations to these different products. Not everybody understands what they're getting into with those. So I do want to take a couple minutes to break those down for a second. So there are 2 very attractive ways to get into real estate as well. If you have equity in existing property that you own, and you have the pretty much fully underwritten financial profile to get into those products. These are going to be products that are fully underwritten by majority brick and mortar banks. There's fintech products popping up here and there on the HELOC side, getting a little creative, but I'm just going to stick to what is existent, that has been time tested, proven, etc. And that's going to be, HELOCs, cash out refinances. So if we kind of start looking at pros and cons between the two, HELOCs, if we start on that side of the equation, are going to be typically going to be second liens on your property, unless you have a paid off piece of property, or you buy the property through a HELOC. That is a thing. First lien HELOCs are a thing. They exist. So generally looking at it, saying that you might have an existing mortgage on a property, and you have decent equity, and you're looking to tap that cash to get into real estate. You're going to need to have decent credit. You're going to need to have decent provable income, verifiable income, decent cash flow. You're looking at a fully underwritten loan. Second lien position, variable interest rate, which right now is funny, because the last, just since the 2020s, that has been not the best. That was a great thing from 2020 to about 2022. A bad idea possibly from 2022 to 2024, and looking like it's going to be a good idea again from the end of 2024 to 2026, 2027 at minimum. Crazy economic system we in right now, but that's the reality on the ground. HELOCs are variable interest rates. They are, closely related to the whole Fed funds rate, Treasury, the 10-year Treasury, that whole little connection of interest rates. They're in that arena. So they're probably going to become more attractive rate-wise in the foreseeable future, but very important to know that they are variable. You're looking at a situation where you're going to have a draw period for X amount of years. An average is around 10 years. And then there's a fixed period where you no longer can draw from that product, but you're going to have whatever is remaining out there that you've used, you're going to have a fixed installment payment. It's going to kind of almost become a mortgage. And that's usually going to be like a 10 or 20-year period as well. So HELOCs are going to be good if you don't want to, like an example would be cash out refinances forcing you to take, if you have a good interest rate on an existing first mortgage right now, like, you were lucky and you got under 4%, in some cases under 3. And you're like, man, I really don't want to lose that rate, but I want to tap my equity. HELOCs are great for that in that scenario. For instance, cash out refis would force you to take on, like, pay off that original first lien, first mortgage, create a new one, and take on today's interest rates, which would be, if your example that I just gave, you're under 4%, under 3%, you'd be doubling your interest rate in the current environment, or potentially more. So a HELOC would be a great product over a cash out refinance if you were looking to protect your rate, for instance, on an existing mortgage. If that wasn't the case, a cash out refinance could be more attractive if you want the fixed rate, stable payments of a regular mortgage loan that's stretched out over 30 years again. So the HELOC is going to have flexible payment terms in the beginning. A lot of times you need to make like these 1% payments, like 1% of the balance plus this fee or plus this interest rate. So it's usually pretty flexible and kind of broadens your cash flow out if you use a HELOC, because they're not looking for that flat installment style principal and interest payment. A lot of times they just want you to pay a little something on it, 1% plus this interest rate, etc., for a period of time. Cash out refinance goes right into installment loan mode and becomes a mortgage again, but it is fixed and stable. So if the interest rate environment went inverse and we look like we were going into a higher interest rate environment, then you would look at a cash out refi and say, okay, I would prefer to, keep a reasonable interest rate and have a locked in fixed payment while exercising the cash that I have, because I plan on going buying this property that's going to cash flow, pay for itself as far as pay out the new mortgage loan or the new debt I took out, and hopefully still cash flow. So that's just a quick scenario of when a HELOC or cash out refinance can serve each other better. It gets deeper than that. If you guys have questions on that, you can comment down below and I can get deeper or clarify further. But that's kind of a scenario of where the benefit of a cash out refinance or the shortcoming of a cash out refinance versus a HELOC and vice versa. Those are two great options. Having existing property that you can pull equity from is great, especially if you have the financial profile to exercise borrowing that equity to get into additional real estate deals. So any equity in existing property is a plus. We kind of talked about retirement accounts already. So I talked about the various ways that can come into play. Private money, hard money. Seller financing is cool too. So seller financing is a really good way that people have learned. It's really kind of a game of negotiations, finding the right seller who's open-minded to the strategy, which usually your seller is going to kind of be your mortgage holder, basically. You're going to be making payments to them a lot of times. A lot of business purchase deals go down with seller financing. A lot of business deals, meaning that buying existing businesses, seller financing is one of the top ways people do that. I see that a lot in my industry, in my field. It's really popular in real estate as well, and it can help subside not having cash flow, not having credit, not having collateral. You're oftentimes gonna not need a ton of cash. You might need a little skin in the game depending on the seller. Think of a scenario where you find a property that somebody's looking to sell, tired landlord, let's say. Property is a 4-unit and it needs some work. It needs some good cosmetic work. It's functional, it's rented out, but you looked at the deal. The owner is already kind of tired or mildly distressed, ready to get off of it, potentially willing to negotiate on price and terms. And you know that you can go into this deal, add value to this property, raise the rents, and create a situation where you're seller financing, that person's getting paid on terms they agree with. You're paying them and still cash flowing on the property because you went in and was able to make the repairs that the landlord either couldn't make or didn't feel like making. and you were able to get the market rents, get the rents up to market rates and etc., add value, force value, if you will. And then you created enough of a spread where you're able to pay off the seller or pay to the seller and then cash flow yourself. This works really well to set you up for regular traditional financing or some other alternative finance to take out that seller at some point in time. Now, in some cases, you can continue that relationship with the seller financing longer term. It does happen. But a lot of times, most people in that scenario, more than not, are going to be looking to balloon it, like to get cashed out and go on with their lives. They're not really going to look to get stuck in those deals, especially if they're older, been doing it for 20 plus, 30 plus years. A lot of times they're not looking to, it works for some. Sometimes that monthly income without having to worry about being a property manager, etc., and the landlord works for some people. But more commonly, from my experience, again, in loan brokering and watching these transactions go down in between, a lot of times people are looking to get out of the way. They will seller finance just to get the deal done. But a lot of times, 1 year, 2 year, 3 year, maybe 4 out to 5 years, where they we'll do this agreed upon seller financing terms. You got to balloon and buy me out at some point in time. So you're buying time to stabilize the property, add value to the property, and then get the rents up, get the value up, whatever the case may be, fix your financial situation, which we're going to also talk about in a few minutes, what that looks like in some cases. And go to a bank or a private or hard money or alternative lender in the real estate space with an existing stabilized property that is in good shape, can pass inspections or can pass appraisals, and has good stable rent rolls. Once you can hit that barrier, seller financing is a gem in that particular capacity. It works really well. It complements really well when it comes to helping you to get in with no credit at that time, very little to no cash, no collateral. That is a gem, and it's really a situation that allows you to take control of real estate until you can completely own it, per se. So seller financing is a nice option. Questions around that, drop it down below. We talked a little bit about peer-to-peer lending. So another one that exists for those of you who are like serious into your business structures, and you probably heard about it, but SBA funding is another option. Now, SBA is probably one I should have started with at the top with the traditional options, because SBA by no means is alternative or flexible. SBA is probably going to be harder than bank financing in a lot of cases. So think of the 7A and the 504 loan. These are two loans that are available for real estate related financing with SBA. SBA is going to be looking for a good, stabilized, quality property most of the time, for the most part. They're going to be looking for good credit, established business most of the time. And then I'm going to, hold on, y'all. So I wanted to double check and see if one of these was startup friendly. And so they are startup friendly to an extent, but you're still looking at a scenario where you're going to have pretty good personal financials when it comes to credit, stable income, and it works in your favor or increases your chances if the business is established with revenues and has credit of its own, believe it or not. SBA is usually more difficult, even startup wise, than most other forms of funding. That aside, SBA is also the most attractive form of funding that you will find out there in most cases as well. So you know how that goes. More times than not, the better the quality, the harder it is to get its hands on or to be attained. That's kind of just how life works in a lot of capacities. When it comes to the lending space, that principle holds true. So SBA is going to be a really good option. Again, 7A and the 504 are two popular ones, real estate related. Not going to dive too far in the weeds unless y'all have questions around it. But I want to just bring up these different forms of financing and just kind of brush over the underwriting criteria So again, the goal is to put these in front of you so you can think about, where do I fall? Which one of these different alternative means, lending means, may work for me to help me get into real estate or further into real estate next year or in the next year or so. So that's what this is about. So I'm brushing past these because I really don't want to drag it out too far, and I want you guys, I just want to turn your knobs on what might be working for you or what could work for you going into the next year or so, that you could qualify for, again, to get started or to evolve further into real estate. So SBA is an option, gonna be one of the most difficult, but the most attractive. Other than that, one of the last ones I want to talk about is going to be, or last couple that I'll talk about, business revenue funding. This is going to be one that'll get you a line of credit pretty easily. So if you have an existing business and you're doing well on cash flow, revenue on that business, then that'll get you a line of credit pretty quick in the alternative lending space and mildly possible in your traditional lending space. I'm thinking of kind of like Amex's business line of credit. They're still going to have lending requirements on credit requirements and stuff like that, but it's really kind of leaning on revenues for the business, and the business being, over 6 months old with decent revenues. So you can get revenue-based lines of credit. That's going to be something that is, I see some hearts popping up over there, so I appreciate y'all supporting. Make sure y'all like, comment, get in the chat. Let me know y'all in the building. Much appreciated. So business revenue will get you a line of credit and the alternative space, and you can use that business funding to get into real estate. So if you have an existing business that's over here doing whatever that business is doing, but it does well on numbers, you can turn around and get funding off of that money and their revenues and branch into real estate. And that kind of also segues into invoice financing, kind of another one that bridges around revenue invoicing. The difference with invoicing is a lot of times this is money owed to you, like future money to come in. Banks and different alternative lenders like invoice funding because that's money that they know is good and should be coming. But revenues is going to be past and present performance, if you will. So you can get a business line of credit off of either of those, and that can serve you pretty well branching into real estate. The last one that I'm going to kind of cover at the moment, and then we'll just talk about tie some loose ends and talk about this at a broader scale to wrap it up. Credit cards as funding options. I know there's so much attention the last handful of years around credit cards as a real estate financing option. My perspective on it, my perception on it, and I'm going to do my best to cover it in depth and do it justice. And then I'm going to give you my criticisms around it. I always say, I'm going to lead off by, I always say, any of you who have, been on my channel, even for the last few months, even if you're moderately new and just caught me in the last few months, you've caught my videos. When I talk about credit cards, I say almost all the time, credit cards are designed as spending tools and not debt tools. Banks are not. That is why it's so expensive to use credit cards as debt tools. People complain about interest rates on credit cards and price gouging and it should be illegal, etc. Whatever. At the end of the day, they're pricing the risk you're taking for using a product improperly, basically. I'm not necessarily trying to advocate for them doing so. I'm just telling you what it is. Credit cards are not really designed for debt usage. They're flexible. They have that back end component. There's the 0% game, etc. When it comes to the real estate hype around credit cards, it's gotten so bad over the years that entire businesses and content creators have built careers basically off of getting people approved for credit cards and rebranding it and packaging it as a funding method. Can't knock a hustle, I guess, right? It exists and it can work. And I'm going to start off by, presenting the picture of where it can work and how it works when you use credit cards for funding towards real estate and business endeavors, but especially real estate for this conversation. You're basically betting on qualifying for moderately decent to high limit credit cards at 0% for as long as possible stacking them up together. And Mike L, what's up, my guy? Better late than never, my man. Better late than never. Basically, just to kind of quickly catch you up. Hopefully, you'll go back and catch the video when it's published, and you'll just kind of catch it from the beginning. But essentially, we're just going over real estate funding strategies, financing strategies that will, give you an alternative if you can't just traditionally walk into the bank and get financing, and help you get into a position where you can graduate into traditional finances. So we talked about a lot of financial tools, Mike. Like I said, I recommend that you finish out the live with us, but then when it gets published, just kind of go back and catch it. I'm going to do my best not to make this a 2-hour plus live unless y'all end up with a ton of questions. I'm going to try to wrap this up relatively soon. We're at the 50-minute mark, but welcome in, Mike. Good to have you, my man. So how this works with credit cards, Wayne, what's up, man? I see you. Again, better late than never. Better late than never. We're going to finish out this live together. I'll try to give y'all a brief recap. I'll answer any questions, and then I'll encourage y'all to go back and just watch the rebroadcasting of the video so y'all can catch it from the beginning. So make sure y'all like, leave emojis, support. Y'all know what to do. Also, real quick, at the very top, pinned to the top, I have provided the ability to reach me one-on-one for consulting. You can book me. I have an official link. I'm going to tell you right now, while I'm accessible and affordable, you guys been following my content. By no means am I bragging, completely humble, but I do value what I bring to the table. I am affordable at the moment. It's not going to stay that way. When you go to check out my booking, you'll probably brush past pricing. You'll see it's really affordable for the value that you know you're going to get if you've been following this channel. It is pinned to the top. You can check it out. If you're interested in getting more one-on-one tailored guidance or advice to, towards your specific plan when it comes to, lending, relationship banking, financing with real estate, building out your credit and credit score, financing and small business banking, building your business credit, etc. All of the topics that are covered by me on this channel. Wanted to throw that out there for y'all, and I'll throw it out again before we get out of here. But anyway, credit card stacking for real estate investing. High limit credit cards, ideally, multiple of them at 0% is the name of the game. It's been branded and packaged as the most phenomenal financing strategy out there for any business needs or real estate investing needs. It can, if it works perfectly. You are going to have to go through the hoops of qualifying for these credit cards at $10,000+ limits, ideally, in order to not stack a whole bunch of $3,000 or $4,000 or $5,000 limit cards to try to get into a deal. 9 out of 10 times, we'll just say north of $5,000 or $10,000 on limits. Multiple of those cards, all at 0%, all typically at one time. And then you need to either find a platform to facilitate the transaction, the real estate transaction through using those credit cards, or you have to find a way to liquidate them, which the vast majority of ways are considered unethical in the mainstream financial world. That's it in a nutshell. How do I feel about it? I'm on both sides of the coin. I work legitimately as a licensed certified professional in the finance space. That aspect of me is not a fan, sees it as a risky way to do business, and something that has tremendous pitfalls to it if done even mildly improperly. That having been said, I'm also somebody who's worked brokering in the independent and alternative lending space, and also had to get very creative with my own finances to build it up to where I am today and continue to graduate on where I'm headed. So I can't sit up here and act like a prude, a nun, a priest, you know what I mean? Like, I can't sit up here and act like I don't understand the use case and the base case for this funding strategy. I get it. I use credit cards as debt tools, even though I tell you they're spending tools and not debt tools. I have a very good understanding of how to use these financial instruments as debt tools and not harm myself. I am pretty skilled at this. A lot of people are not. You have to have a really good plan in place, backup plan in place, in order to make sure you don't get caught into the real debt trap of finding a way to get your hands on this money, these financial tools, deploy them into whatever you deploy them into, and it doesn't work out the way you thought it was, or it takes longer than you thought it was going to take. Your 0% runs out, and now you got 20-some% interest rates on tens of thousands of dollars compounding. So I am not against this as a funding tool, but man, when I tell you, you need to have a plan for sure. Low barrier to entry is great. Almost anybody can position themselves with a little bit of gumption and a little bit of discipline and some focus to qualify for a $10,000 limit on a credit card. When you can do it once, you can stack it, because now you play the game of bureaus, like layering on bureaus. So I'm gonna pull one from Equifax, pull one from TransUnion, pull one from Experian. That's $30,000. If it's $10,000 a piece, that's enough for me to go get into this real estate deal. So easier access, lower barrier to entry, low to no documentation. If you can get over the hurdle of finding a way to deploy them into real estate, then cool. Plastique, Melio, some of these platforms that will allow you to use a credit card to get in, to closing companies, and they will kind of be the middleman between you and a title company, rather, to close on a real estate deal. They exist, they charge a fee, but you stay on your 0%, and typically are able to not trigger or piss off the bank that the card that is issuing you the card. So that's a thing. It exists. It could work. It does work. It has worked for people. You also have the other back-end methods of trying to buy a bunch of items from a given store, playing a credit card, debit card game, and, using a bulk of your credit card limits to buy electronics from Best Buy, and then turning around and returning it. And they, because you use your debit card for a part of it, they return it back to your debit card, all of the money back to your debit card, kind of basically liquidating or transitioning those limits from credit to cash in your account. There's those methodologies. There's, working with, and then on some occasions, I've seen people literally get their own merchant services through a different business entity, charge those cards through those merchant services, and have that money returned to them, either through a separate person they trust, or somebody else that's doing it as a business model that they trust, or doing it in some cases with two different businesses that person owns, if they can pull it off. You see where this is going. It works. People are doing it at scale. It's risky business. It is unethical, generally speaking, in the finance space. And if it doesn't go right, you can be risking banking relationships, and you could be risking looking like you are a fraudster or borderline a financial criminal, a white-collar criminal. That all having been said, if this plan works, if that strategy works, you are looking at getting tens of thousands of dollars, in some rare cases, hundreds of thousands of dollars in funding at 0% to deploy into real estate. I can't knock anybody that sees that as a sweet deal. Who wouldn't want that? I get it. If you have the acumen and the testicular fortitude to pull off that strategy, credit card stacking can work in real estate investing as a funding method. You can leave your questions or comments down below. I am not the kind of person that, again, I am not a saint. I'm not, as far as, trying to play financial police or anything to that nature. Ricardo, my man, welcome in the building. Welcome. I got all my guys in the building, slowly but surely. But credit card stacking can work, and it can complement some of the previous strategies we talked about. So private and hard money, seller financing, these different deals that might need those injections of cash. This credit card stacking, credit cards can come into play and be a great tool. Make sure y'all when y'all come in, make sure y'all support the video. So just to give a brief recap for a lot of my guys coming in late, we covered a good handful of alternative lending products. Not every, but a good bulk of the alternative lending products out there that are available. And with the concept in mind of trying to trigger for you ones that may be something underneath in your hands, in your possession, you don't realize could be working for you to help you get into real estate in the next year or so, and how to stack them up and get them to complement each other to help you get that portfolio snowballing. I am all about, as I said at the very beginning of the video when most of you guys aren't in yet, I am all about getting you to those 3 C's of underwriting: credit, cash flow or cash reserves, and collateral. When you have those 3, almost every lending product is based off of at least one, if not all 3 of those. If you look at any lending product out there, it's going to be leaning against your financial reputation, aka your credit scores, cash reserves or cash flow, whether that's invoicing, existing revenue, existing income, or collateral, tangible or intangible. As I just mentioned, physical property, physical equipment, or invoice factoring, things of that nature. Something of the sort of those 3, some variation, is going to be lent against in the financial space when it comes to business and real estate financing. Period. I am all about on this channel bringing you the kind of content and financial guidance that's going to bring you in a position where you have all 3, because that's going to give you the bargaining power and the negotiating power at any table with any bank and financial institution or alternative lender when you are building out your financial portfolio for business, acquiring businesses or funding your existing businesses, and buying real estate. In this video, we're focused on buying real estate. That having been said, many of us, myself included, may be at that 2 out of 3 mark. We might be in that 2.5 out of 3 mark. We might be at a 1 out of 3 part, as far as like having 1 out of those 3. So we need to understand what's available to us now to help us keep growing. And that's what this live stream has really been focused on, is helping you to understand until you get pristine credit, good cash flow, cash reserves, collateral, great tax returns, till you get this whole package put together and can walk into a bank, give them email them a file or bring in your physical documentation and check every box that they need for underwriting. We need to take what we have available to us now and build out a portfolio to get ourselves there. I am not a proponent of getting a long-term marriage on hard money, private money, alternative lending sources. We named a bunch: private money, hard money, self-directed IRAs, 401k financing, securities-based lines of credit, peer-to-peer lending, credit card stacking, seller financing. I am not a fan of these strategies for the long term in your real estate portfolio, only because in most cases, not necessarily every single one, there are exceptions, but in most or many cases, they are more expensive and the terms are often less favorable or can be less favorable than traditional financing. Walking into a brick and mortar bank and getting a flat out, low interest rate, fixed 30-year loan. We had talked SBA too as well. When I missed that when I was listing out those options. So they're great to get you snowballing and get you started. Any of the ones I just named in conjunction with each other or one at a time will get you started or get you to the next level in real estate investing. And that's the goal. We want to, as I said at the top of the video as well, residential real estate has been hot since the 2008 crash, the recovery of the 2008 crash. Think 2010, 2011, and it hasn't seen a bottom since. It's been up ever since. Even with interest rates at 20+ year highs, it could not suppress the majority of residential real estate markets around the country. There was some exceptions, but in most markets, real estate held strong and is, as a national average, appreciated through the highest rates in over 20 years. That's a lot of downward pressure that real estate still grew through. That's basic economic 101s and fundamental reasons why real estate continues to grow, residential real estate in particular, supply and demand. And that's going to stay a problem for the foreseeable few years. So that means we need to get in on real estate from a primary resident and an investment portfolio as soon as possible in order to ride that wave up, to build out a strong financial portfolio, start to develop some independence for those of us still working corporate jobs. Not that real estate is the only way to do that, but we know it's a very attractive way to do that. And to not get priced out of real estate long term for ourselves and our families. I'm not sure how many of you have kids or anybody that's leaning on you that you're financially responsible for, or plan to have kids or have other siblings, etc. Maybe you still have even taking care of your parents. Whatever the case may be, it's bigger than us just patting our pockets. Real estate is one of those tangible assets that is a long-term legacy play. We know 9 out of 10 times, 9.9 out of 10 times, real estate is going to be there the long term. So I got a question, my guy Mike. Is it a site you can use to find real estate so you can use your credit? Clarify, clarify that one for me, Mike, so I can make sure I'm understanding the question. You said, is it a site you can use to find real estate so you could use your credit? So just clarify that one for me. Are you asking the site to find real estate deals and use your credit alone to finance them? Clarify that one for me real quick, Mike, when you get a second. So real estate is a legacy play. We know that. I'm here to bring you the framework, the blueprint on the different tools available to you now if your credit isn't the best. Now, if your cash flow or cash reserves is not the best. Now, if you don't have collateral. So, yes, on what I said. So, yes, Mike, there are sites and even softwares that exist. And again, I know this from brokering independently, alternative and basically like private market real estate deals. Like private and hard money lending was something that I did brokering like myself. So I know from that space that there are different companies, there's websites and softwares that exist that will give you the data on real estate around the country. And, you can say help you find a deal. You know that there's like these more prominent in the space. So I'm gonna name a few that come to the top of my mind. There's more of them. If you Google, it's the Wild West. You'll find a ton. Not all are legitimate. Not all are worth it. But like Connected Investors is a full platform, social media company. Real estate financing, like a whole conglomerate, if you will. And that's Connected Investors. If you've never heard of them, they've been out for a while. I've kind of like brushed past them in the private lending space when I was doing the business there. Legitimate company. They have software that they sell that gives you a bunch of real estate data and will find vacant properties for you, properties that are pre-foreclosure, that kind of thing. It is a software that they typically sell. And then they also offer the financing for people like myself who are in private brokering or family hedge funds and family offices that have the lending, the capital to finance those real estate deals. So they try to be an all-in-one platform. PropStream is another software that's out there that will help you pool a bunch of real estate data and like search properties that are also going to be vacant, foreclosed on, pre-foreclosed, that kind of thing. I'd have to do some more digging. There's a good bit of them out there. I'm looking at one right now and I'm drawing a blank. But yes, Mike, they exist. They're mostly going to charge you for those softwares. And that's not saying that's a problem. I mean, we're in a capitalistic society. Stuff is going to cost money. What I am saying is, in case it mattered to you if it was free or not, I haven't run across any quality free softwares. I mean, you can get really creative with like Zillow and Redfin and kind of find that. Yeah, Mike, I'll type those out for you. I'm going to try to look them up too to make sure I'm spelling them right. Connected Investors. You can Google them and find them pretty easily. And the other one is PropStream. And I'm going to double check that for you real quick, Mike. Let me just go ahead and just type. Let me check that out. Yeah, I got it right. So that's PropStream. And let me type that one in for you real quick, Mike. Bear with me for a second. If you're catching the replay of this video and don't lose your focus on me, I'm gonna wrap this up for you guys. But yeah, let's look that up real quick. So yeah. Prop stream. Connected investment and price. Of course, Mike. Of course. Hey man, if y'all ain't figure it out yet, I'm all about making sure that I assist y'all to the best of my ability. Give a lot of free resources on here. So all I ask for now is y'all support the channel. There will be new ways to come out to support the channel. For all my real pioneers, that's gonna be coming out in the next couple of weeks or so. So y'all keep locked in for opportunities to really kind of partner with me and grow with me on this channel and continue to grow my reach to more of you. And just to show your support back for the channel for the free resources given. It's my pleasure to help assist y'all and continue to help give y'all the resources to continue to grow. So I appreciate y'all. But yes, just kind of tying this up real quick. Any questions real quick, before I wrap this up on the various funding, lending tools available that I might have covered or that you're curious about that I didn't cover that may be within my wheelhouse to speak on. I didn't even talk about insurance, life insurance. That's a whole nother beast, but that is one that I am really salivating at the opportunity to start covering in my community. It may not be on my YouTube channel because, again, I get a rough time from YouTube whenever I steer or deviate off of certain topics. And I am looking to grow the channel, but as my community grows, all of you will be, informed on the various ways that I am putting out content and just overall growing, the financial tools that I can cover to help you guys grow. So I will be doing somewhere I will find a way to really talk about life insurance as an asset tool, as a lending tool, etc. But any questions around the alternative lending space, real estate funding and financing, curiosities, again, I make it abundantly clear. I own a little bit of property, but I don't have a ton of experience in acquiring real estate. I am on that journey with you guys. My experience and expertise that you're getting from me is the lending and financing capacity that I can speak to at depth and go head to head with a lot of people, not necessarily the deal making and the deal finding per se. I'm giving you from my experience, but I can give you the lending and the financing component in depth for sure. How do I get a business line of credit? P&R, great question. So do you want me to answer this question for you from what capacity? As in where to go for it? What tools to qualify for one? Like, how do you want me to answer this question just to make sure that I don't give you a bunch of fluff in responding to you? Let me know how you would like me to answer this question, because I can answer it a couple different ways or I can kind of pool it together. Any other questions, though? Any other questions, y'all? I'm not going to let this one run to 2 hours this time, y'all. So if y'all got questions for me, I know y'all kind of came in later. Do you have any questions around alternative lending options for real estate investing, stacking them together? Do you, why you got me right now? Any questions? Any questions? Y'all let me know what y'all thinking. I also want to keep this kind of condensed because I know people are watching the replay or going to watch the replay. Tools to qualify for. Gotcha. So business lines of credit in the most traditional forms, P&R, you will need full underwriting. That's the highest end of the deal. So credit, personal credit, helps to have business credit. Revenues, business established for over a year plus is ideal. And tax returns, financial statements, balance sheets, etc. Alternatively, you can pull a business line of credit from revenue alone. You can pull a business line of credit from invoicing if your business functions in that way where you get invoicing. You can pull a business line of credit from equipment or collateral. So if there's tangible assets, tools, equipment under your business property, whatever, you can get a line of credit off of it. You can get a line of credit on the business side from, let me say that a little differently because I'm about to go back to my securities-based line of credit. You can get a stock portfolio in a business. A lot of people don't know that, but it is possible to do a stock portfolio in a business. But I'm going to answer this as if you have a personal stock portfolio, securities-based line of credit, you can use it in your business. So business line of credit, BLOC, You're going to be focused on revenues, ideally, invoicing, collateral, equipment. That's going to be your big hitters. Not really something you're going to find much of from just credit alone. Usually it's going to be more revenue focused and collateral focused, P&R. So if you and I were to talk one-on-one, I would kind of like go over a list of questions or things that you might either own or go into a depth on how your business functions and what you might have going on in the business. And we'll kind of give you a breakdown on, okay, that might be something you can collateralize or lend against or go to here and possibly get a business line of credit against. But generally speaking, especially if credit is like not, like you don't have, like I said, 2 out of those 3 where it's like I got credit and cash flow or, revenue, etc. If you just have the revenue, if you just have invoicing, if you have equipment or collateral, there are options tool wise, like qualifying wise, for business lines of credit in that arena. Let me know if I answered the question in depth enough for you or from the angle you were looking for. I can go further with that or go on a different angle if you need me to while we got a few minutes. Let me know if you need more than that. Anybody else with any curiosities or questions around real estate financing? I'm cool with business lending questions because that's kind of all bridged together. You can use your business finance to get into real estate. So any business funding, real estate funding related financing questions, alternative, traditional. You got somebody right now, again, that has a mixed, in-depth, at this time, over 13-year career in the traditional brick and mortar, banking space, as well as been, 10 toes into the loan brokering, business lending, alternative real estate lending space as well. It's not often you get somebody that's done both. And you get one side of the argument or the other, but usually you don't get somebody who's done both. Any questions real quick before we get off of here for the night? Any questions? Any curiosities before we? Cool, PNR. Yes, sir. Of course. Of course. Any questions? So what I would like for you guys to do is I'm going to task you a little bit of homework. I want you to think about the lending options that I covered. For those of you who came late, take the time out, catch about the first 30, 40 or so minutes of the video of this live stream on the rebroadcasting, on the replay, and just catch those topics that I covered and the way I covered them and see what you have in your tool set. If any of you are not actively, if you plan on getting into real estate or you already kind of have, but you're not like actively gobbling up real estate from a financing available point of view, then that means that there's room for growth for you there, which there is for all of us, by the way. I want you to leverage the tools that I put in there. Think about what I may have covered, or at least may have triggered your thought process to what might be available to you for you to get into real estate or get deeper into real estate. This is not the only means of building wealth, but it is a hell of a means to building wealth. And the financial system is one of the few assets that the entire financial system agrees on. What I mean by that is, from a tax point of view, the banking system and the government, like, all in support of those of us that own real estate. It's just one of those assets that's not easy to go wrong with, in a sense of speaking. You can buy a bad deal, you can pick a bad deal, but at the end of the day, real estate as a whole is just a smart move. So I want to see, you got any of you who are my OG pioneers, like prior to all of the, the investment in editing and stuff like that, back when these videos were just raw footage. You heard me say is my intro, and it's the same pillars that exist. Help you master relationship banking, maximize your funding capacity, proper use of life insurance, and the ownership of real estate. That was my promise and still is my promise on this channel. And all of my content is some kind of way or another is a tentacle back into those 4 principles, because those are going to be the ones that it's not possible for you not to build wealth and not to become financially successful and independent if you got those under your belt. It's just not. So, and that's also my expertise. These are things that I try not to speak out on. You don't hear me talk about a whole lot of stuff on this channel because it's not in my wheelhouse. So you won't be getting a bunch of BS from me trying to cover topics that are not in my wheelhouse. So I want to see more of you in real estate, deeper in real estate. Follow, like we should be locking in on this journey, hand in hand in the sense of speaking, because this is where I'm focused at in 2025 is growing my existing businesses. Of course, making sure that my corporate career is strong, but growing my existing businesses, including this channel and my entire network that's going to come from this, as well as advancing into real estate further, diving into real estate. We're going to create goals. We are going to create goals for 2025. What are we looking to accomplish when it comes to real estate acquisitions in 2025? I don't care if it's just buying your first rental property. I don't even care if it's buying your primary residence in 2025 if you don't already have it. But that's going to be something that we're going to lay out for each other in 2025 as we get closer to the end of the year and start laying out what we plan to do for the next year. As men, we are structured. We have goals. We have long-term vision. We know what we need to be doing. And we need to make sure that we constantly have a plan in place and that we have the tools and resources to execute that plan. 2025 needs to be a year. Interest rates will be coming down. We will have a new president one way or another. So policy changes. The economic landscape is going to change in 2025, my guys. And and on the replay, my girls, my ladies, my women, for those that are gonna catch it, it's going to change in 2025. So wherever real estate is for you, as far as accessibility, it's good chance it's going to become less accessible to you as time goes on. Residential real estate in most markets, not all, is likely going to go up. We need to get on that train. We need to catch that ride and that elevator going up. So we need to acquire property next year. I want to help you on this channel. Get your credit together. Even if you have a hardship, I want you to get your cash flow, your cash reserves together, and I want you to get collateral together. I want you strong across the board. I want you to be able to walk into any financial institution and get whatever the hell you're looking for. Whatever financial resource and lending product you're looking for, I eventually want to see you get to a point where you're not begging, pleading, kind of qualifying, negotiating, and none of that. We are men. We're going to dominate our space. We're going to dominate our environment. We're going to control our space. We're going to make our families better. We're going to control the environment around them, and we're going to make our communities stronger. We have to do that through wealth building. Health, wealth, family, freedom. That is what we're focused on. If I haven't laid those principles out, you're learning more about who I am on the inner fabrics. That is what I'm about. So in order for us to control the environment around us as men, we have to dominate our wealth, and we're going to do it ethically, responsibly. We're going to do it in a way that we can be proud of. We're not going to be snakes. We're not going to all these backdoor hack fancy strategies and all that. You notice I don't cover hardly much of any of that stuff. I don't. We're going to do this the real way. Even if it's harder and the path of resistance is harder, we're going to do it the real way. So those of you who, I'm sure many of you have responsibilities, you have families, you have obligations, whatever the case may be, you have a purpose. I know you do. Watching this content on a Friday evening says a lot about each of you. Facts. Like watching this content on a Friday evening when you could be doing all kind of stuff to entertain yourself. You could be out anywhere watching anything. You are literally watching a raw live stream that don't have all the fancy props and edits on it and having raw, real conversation, dialogue, and learning. Says a lot about each and every one of you. So each and every one of you are already special. You're already solid because most people are lame. They're out partying, drinking, smoking their life away, footballing, sports, reality TV in their life away, and you're on this live stream learning. So you need to understand you have a purpose and that you're very capable because you're already doing a lot of the hard work. The education part is the hard work. It's part of the hard work. Once you have the education, putting a plan in place is a different beast. Things start to flow. They fall in place. So you doing the education right now says a lot about each and every one of you. And I'm here as long as you're focused and tied in. I'm not going anywhere. You know what I'm saying? Heaven say the same. I'm not going anywhere. So I'm gonna continue to support y'all and bring y'all the cutting edge quality content and a variety of avenues to keep you growing. And I'm gonna continue to, whether it's these live streams, the frequency of these live streams. As I mentioned, there's going to be other ways for you to invest in this channel to make it more possible for me to reach out one-on-one, do more live streams, video responses. I don't want this channel to be one of these channels where we putting out all of this information or these fancy financial topics, but you can't get the direct engagement that you need to grow. My goal is to be directly as accessible to you guys as possible. I am here to make money. I'm here to grow. I'm here to profit. I am not to be picked off of or, like manipulated or used for free. But I am willing to give free resources like these live streams to help each and every one of you that is trying to help themselves. So my guy Wayne, PNR, I see y'all with it. I'm with it. Let's get it. 2025. I know most of you came into this community as my partners in 2024. So we'll consider this as our year of gearing up and prepping up. We getting to it in 2025, gentlemen. That's what we're doing. We're getting to it in 2025. We're going to hold each other accountable. We're going to stay locked in. If we need assistance, we're going to be there for each other to the best of our abilities, and we're going to keep growing. That's the goal. So I'm in it. I'm with y'all. I'm in it. We're going to start broadening the content in this channel out. We're going to stay focused on the finance. We're going to broaden out on other topics that are important to developing our health and well-being, our wealth, and becoming holistic, and becoming whole, solid, strong, in control of our environment. So we can have, again, do better for our families, do better for our communities. So that's what we're about to be up. That's what we're on. That's what we're about. Going into 2025, we're going to put that into motion. So any final questions? We had an hour and a half nearly. I see most of y'all are still locked in. I appreciate y'all. Any last comments, questions, thoughts, topics, any inputs on the next live stream for next Friday? Feel free to drop it in the chat. I'm going to give y'all a few more minutes to let me know where y'all at with it. Any questions, thoughts, comments, concerns, exciting news, whatever. For any of y'all coming in late that were watching the news and keeping up, I was in the pathway of Hurricane Francine. I want y'all to know I made out pretty good. It was another motivational stretch to make sure that our finances are together and in order, man. I'll tell y'all that for sure. See you next week. Take it easy. All right, PNR, I appreciate you. Good to see you, my man. Stay up, stay focused. I will see you next week. Hopefully you'll take the time to catch the other videos, long forms that'll be coming out in between now and next week as well. But if you're signing out, you have a good one, my guy. Anybody else, any questions? Last few minutes. We wrapping this up right at that hour and a half. We had a minute 27. Any questions, final thoughts before we get out of here, y'all? Any final thoughts, questions, topics, inputs? Wayne, you out. All right, my guy. Appreciate you. Stay focused, stay strong, stay focused, stay in motion. I'll see y'all next week. I'll see y'all in the long forms coming out, Sunday, Wednesday, etc. I'm going to see y'all in those, and I'll catch y'all in the next live stream. Anybody else before they sign out? Questions, thoughts? Anybody else? Going once, going twice. Going once, going twice. I appreciate y'all, man. I appreciate y'all. Looks like they got it off. Any last thoughts? And just to let y'all know again, link is in the top. Looking for any one-on-one consultations. I'm accessible at the moment and affordable at the moment. Link is at the top for any of y'all in that are curious more on a detailed financial plan or consultation around where you are, banking-wise, small business funding, small business financing, personal financing, credit, funding, real estate funding, etc. Any questions around this? This is your opportunity. Link is at the top. I see y'all dropping out, so I'm going to assume everybody got their questions answered and they're good for now. That being the case, I appreciate every single one of y'all. Y'all have a good evening. Stay safe until the next live stream. There will be long form and short form content coming out soon. I want y'all to stay focused, stay in motion. I'll see y'all soon.